A very good morning to you and welcome to another Morgans Edward Street weekly wrap for the week finishing the 10th of November. And what a week it was. We've seen the ASX 200 break through key resistance of 6,000 points, and this has put the market at 10-year highs and have the bulls well and truly in control at this point. We all know how quickly things can change though, so the true question remains, where to from here? As usual, please note that the comments in this video are general in nature, and please speak to your Edward Street Morgans advisor if you wish to know if any of the stock's recommendations suit your personal needs and objectives. I'll now pass over to Bradley for his macro summary and views on the market.
Thanks, Cam. The return of some merger and acquisition activity to Wall Street helped lift the benchmark US indices to fresh record highs. Semiconductor giant Broadcom offered to acquire fellow chipmaker Qualcomm for $80 billion US. Reports also emerged during the week that 21st Century Fox has been holding talks to sell most of the company to Disney. It hasn't been all rosy though, with Thursday's session ruining the party. US equities fell, pulling back from record highs on worries that a corporate tax rate could be delayed. A proposed plan by Senate Republicans would push slashing the corporate tax rate from 35% to 20% out until 2019. The move contrasts with a bill working its way through the House. The proposed Senate measures would also alter the individual tax system. In metals, copper and nickel posted gains on the LME amid ongoing upbeat sentiment around the potential demand from electric vehicles. Copper is on track for its sixth consecutive quarterly gain, having climbed 7% this current quarter. Nickel also in focus, with Goldman Sachs upgrading their forecast for the metal, citing near-term support from China's pollution crackdown, saying electric vehicles are a theme for 2020 onwards. US 10-year Treasury notes are at around 15 basis points below their recent high of around 2.47%, following a speech from Federal Reserve President William Dudley, in which he urged Congress not to lose sight of the horrific damage caused by the financial crisis, including the worst recession of our lifetimes and millions of people losing their jobs and homes, in their deliberations on whether to roll back regulations implemented during the financial crisis. In stock-specific news, on Monday, Westpac reported full-year 17 cash earnings of $8.062 billion, 1% below consensus expectations. Westpac declared a final dividend of 94 cents per share, fully franked. Net interest margins expanded 3 basis points, half on half, less than the 5 basis points Morgans analyst Azib Khan had expected due to a drag from Westpac's Treasury and Markets division. The full year 17 credit impairment charge of $853 million was better than Azib's forecast of $910 million. New impaired assets decreased from $589 million in the first half to $40 million in the second. Westpac reported an APRA Common Equity Tier 1 ratio of 10.6% as at September 2017, slightly higher than Azib's forecast of 10.5%. Overall, a solid result. The Treasury and Markets division was the key drag, albeit this is an inherently volatile source of income. On Wednesday, CBA provided a first quarter trading update. Unaudited earnings of $2.65 billion for first quarter, which on a run rate basis is in line with Morgans analyst Azib Khan's forecast and 3% better than consensus forecast. Operating income is a little softer than Morgans had expected, but the overall asset quality trend continues to improve. CBA is up 4% since the update. And look, lastly, during the week, there was fresh press speculation in the Fin Review that Royal Dutch Shell may take the opportunity to head for the exit and sell their 13.28% stake in Woodside amid the latest rally. Woodside's share price has rallied 20% from the lows in September, hitting a high of close to $33.40 during this week. Shell secured a price of above $40 when they sold down their stake in Woodside back in November 2010 and in June 2014. Thanks, Cameron.
Cheers, Brad. With the absence of a third member today, I'll be plugging the stock this week, which is Bravura Solutions, code BVS. Bravura provides software products and services to clients operating in the wealth management and funds administration industries. BVS is headquartered in Sydney and has global exposure with operations in the Asia Pacific region, Europe, Middle East and African regions. So why do I like this company? Well, firstly, the company operates on strong fundamentals with a forecasted return on equity of 22%, trading on a PE of 15 times with strong earnings growth. BVS has a net cash position which gives them the opportunity for further growth and the chance to further scale their business. Secondly, I like companies operating in this space which have benefits of high barriers to entry, recurring revenue streams with low capex and working capital requirements. BVS listed last November at the IPO price of $1.45. The stock has recently been well supported, now trading at $1.80. I'll be looking for entry on any weakness. I note that this stock is not covered by Morgans and is my own personal view. Thanks, Brad.
Thanks, Cam. Quickly, it's been a long video. Ex-dividend dates of note next week. We have ANZ and Westpac on Monday. ANZ is paying 80 cents fully franked and Westpac 94 cents fully franked. That's it for another wrap. Please feel free to share this video with your colleagues and friends and make sure you like the Morgans Edward Street Stockbroking Facebook page. Also, subscribe to our YouTube channel below. Have a great weekend.